Stock of the Day is brought to you by IG, Australia's #1 CFD provider. Trade over 17,000 markets with extended trading hours on key US shares and competitive spreads, all on an award-winning platform. Get started at IG.com.
And the stock of the day is Reece. So one of those companies holding its AGM. It still expects soft activity in the US and in Australia and New Zealand. Over the first quarter, adjusted earnings were down 18% year on year with high depreciation and amortization costs. Reece says this is because of investments into the business, while sales on a like-for-like basis edged up 2%. Shares are, higher today, up by 2.5%, but it's one of the worst performing stocks year to date on the ASX 200. Look, this is a bit of a sad story, isn't it, as of late? Being exposed to the US, Claude, many people used to call this a very quality business. Do you think that this is a blip in the road or has something fundamentally changed at Reece?
I think that it was an overestimated business for a long time. I think that they had there was more luck involved in how the business had flourished in Australia than people realised. And also, when you think about it, this halo we often give a founder who has genuinely built the business themselves through their hard work from the beginning and probably take big risks. I think that the market makes a mistake when they these founder halos are non-transferable. Like, you can't inherit them from your dad. Just because your dad's good at something doesn't mean you're going to be good at something. You need to find your path. What are you best at? What are you meant to do? Coincidentally, same as dad? Well, maybe, but they're non-transferable, right? So it's not a founder-led business, in my opinion. And I think that we're seeing the problems of that right now, because what happened is they had internal debate and disagreement about whether to do this disastrous US acquisition. And they were literally the patsies at the poker table. Whoever the old guard were, saying no, don't do it. Let's just stay in Australia where we built it and we know it and we're the kings. They did this huge diversification effort. Someone in the US literally was a founder, knew the value of his business, and sold it to these Australians who thought they were so clever. And there's no how is that? How does this pass the management criteria? There's so many fund managers we care so much about management. Does that mean that you're skeptically appraising their performance, or does that mean that you're going out to lunch with them? Because clearly there's needs to be change in this company, and I think that that's definitely a future for Reece if it ever became a company that was run in order to maximize its competitive advantage in Australia. And I could see it being ascendant again, but I wouldn't touch it right now. It's just not that cheap either, given its performance. And even its update was pretty tepid. The numbers were like-for-like sales up 3%, EBITDA down 8%, EBIT down 18%. And they've been buying back shares at higher prices.
Yeah, I know, that was pretty controversial.
Thus increasing their interest costs, right? Now, I've just said how my view is I actually think inflation is going to be higher than people think. I'm not going to get into some company that's just borrowing money for the sake of it, and they already borrowed heaps to make a bad acquisition. This is not the capital allocation I want with my capital. So no way, I would not buy it, I would sell it. And look, mate, it could come back one day. It's got a very good distribution network in Australia, but nah, not now. Okay,
Luke, what do you think about Reece?
I agree with that. I think it's a sell as well. And I think we've seen this with a few stocks on the ASX. CSL's obviously getting the headlines, and it hasn't been as bad as Reece, but rewind a few years ago and everyone wanted to pick on Pro Medicus, WiseTech, whatever, as being too expensive. To me, the bubble in expensive stocks on the ASX was these compounders, where everyone just went, this business is executed for 15, 20 years. And I just went and checked. Reece was trading over 50 times earnings a few years ago. That is just an absurd price to pay for this type of business. At best, you were going to get high single-digit, low double-digit EPS growth. And just the maths on making 50 times earnings work just doesn't work. And so we've seen that share price chart. It was down 50%, I think it was, over the last 3 years. Some of that's obviously earnings have come down. Claude highlighted that. Most of it's just multiple compression. That multiples come from 50 to 21. And I think it goes lower. Why doesn't this business trade on 15 times earnings, which is a normal market multiple for a cyclical low growth business?
And what GWA, a similar business, actually trades on.
Yeah. So for me, I think there's more pain to come. Unless you need to have a view that yes, that they're significantly under earning right now, and the US is probably the answer to that. Turn that around, US growth comes in, and I think earnings can grow at 10-15%, and the share price might correspond. But if your thesis here is low single-digit revenue growth, a bit of margins, a bit of share buybacks, whatever, and I can get EPS of 7 to 8%, to me, that's a market return, and it should trade on a market multiple, which is still 30-odd% lower.
Yeah.
Good. Well, that's the stock of the day. That is Reece. It's a sell from both of my guests.
The stock of the day was brought to you by IG. Trade over 12,000 shares and ETFs, including major tech giants with extended hours on an award-winning platform. Get started at IG.com.